Stop gambling with safe stocks, because the ones that look safest can still wreck your money in the next downturn. If you stay with me for the next few minutes, you'll learn Philip Fisher's 4-layer sleep well framework for conservative investing, how to spot companies that can survive recessions, inflation, bad management decisions, and sudden change, and still deliver solid long-term returns. By the end, you'll have a simple mental checklist to judge any company. Is this truly safe or just familiar? Now, here's the key. Conservative investing isn't about being timid. It's about owning businesses so strong that when storms hit, they don't just endure, they gain ground. All right, let's begin. Part 2, Chapter 1, The First Dimension of a Conservative Investment. As Fisher moves into Part 2, Conservative Investors. Sleep well, he shifts his lens from high-growth investing to preserving wealth without sacrificing reasonable returns. This section is for investors who want their money to work hard, but safely. And in this first chapter, he introduces what he calls the first dimension of a conservative investment: relative stability and strength of the business itself. At its core, this chapter answers a vital question. What makes a company safe, not just today, but through economic storms, market crashes, and changing times? The idea of safety has layers. Fisher begins by challenging the traditional view of conservative investing. Many people think a safe stock is one that has a high dividend, belongs to a well-known, slow-moving company, has a low price-to-earnings (PE) ratio. Fisher says, none of these alone make a stock safe. True safety, he argues, comes from business strength, a company's ability to withstand external shocks, economic downturns, competitive threats. Even internal missteps is what makes it truly conservative. And this strength isn't always obvious. Sometimes the companies that seem the most boring or stable on the outside are sitting on weak foundations. What does true business strength look like? Fisher breaks it down into several practical signs. 1. Durable demand. A conservative investment should offer products or services that people need in both good times and bad. Think of businesses that are essential, not optional, like consumer staples, utilities, or infrastructure services. For example, Procter & Gamble makes items like soap, detergent, and toothpaste, things people don't stop buying during a recession. These are the kinds of businesses Fisher suggests conservative investors focus on. 2. Market leadership. The company should have a defensible competitive position. That might mean strong brand loyalty, economies of scale, proprietary technology, or regulatory protection. Fisher believes that market leaders are far more likely to survive downturns and emerge stronger when competitors falter. The moat matters. 3. Financial resilience. This is a big one. A truly conservative business avoids excessive debt, maintains strong cash flow, can self-fund its operations even when sales decline. During economic downturns, weak companies scramble for capital. Strong companies stay steady or even acquire their struggling competitors. Fisher warns that even a great business can become risky if it's too leveraged or over-dependent on external financing. 4. Managerial prudence. Leadership that's smart but not flashy tends to keep companies safe. Fisher values long-term thinking, conservative financial policies, a clear understanding of risk. In fact, he criticizes executives who chase quarterly results or expansion for the sake of growth. He wants calm, competent managers who know when not to act. 5. Historical track record. Fisher advises looking at how a company performed in past recessions. Did it stay profitable? Did it protect shareholder equity? Did it maintain dividends without cutting essential spending? He points out that history can't guarantee the future, but it can show how management thinks and how resilient the business really is. Being conservative isn't about fear, it's about strength. Fisher makes an important distinction. Being conservative doesn't mean avoiding risk altogether. It means taking calculated risks only when the odds are solidly in your favor. And for long-term investors, business strength is the first layer of protection. He emphasizes that conservative investing is not about settling for mediocrity. A company can be safe and grow. In fact, strong businesses often do both, growing slowly but steadily through reinvestment, expansion into stable markets, and operational efficiency. What about bonds or safe sectors? Fisher takes a shot at the idea that bonds are automatically safer than stocks. Yes, bonds may be less volatile short-term, but they're vulnerable to inflation, currency devaluation, and poor interest rate environments. Over long periods, stocks in strong companies often outperform bonds with less real-world risk. He also warns against blindly trusting safe sectors like utilities or banks. They may look stable, but without understanding the underlying business and leadership, they can be just as risky or more so than carefully chosen growth stocks. The key question to ask yourself. At the end of the day, Fisher encourages you to ask, if the economy went south for the next 18 months, would this business survive and come out stronger? If the answer is yes, you may be looking at the kind of company a conservative investor should own. Takeaways from the first dimension. Safety doesn't come from dividends or low PES. It comes from business strength. Look for essential products, market dominance, and strong cash flow. Avoid heavily leveraged companies even if they look exciting. History matters. A proven track record in tough times is a huge plus. Conservative investing means being selective and disciplined, not afraid. In closing, Fisher sets the tone for the next chapters. Building a conservative portfolio is like building a fortress, layer by layer. And the first layer is a company so strong it doesn't just survive tough times, but thrives because of them. Because that's what lets conservative investors sleep well at night. Part 2, Chapter 2, The Second Dimension. In this chapter, Philip Fisher introduces the second dimension of a conservative investment, the quality of the people running the business. If the first dimension was about a company's business strength, this one is about management strength, and Fisher believes it's just as important. He starts with a powerful idea. Even the best business can be ruined by poor leadership, while an average business can be transformed by excellent management. Fisher doesn't just mean CEOs who speak well or have impressive resumes. He's talking about people with character, clarity, and competence, leaders who guide the company wisely through both boom times and downturns. Let's explore what Fisher looks for in high-quality management and why it's a cornerstone of safe, long-term investing. 1. Integrity comes first. Before anything else, Fisher wants to see unquestionable integrity in the company's top leadership. He believes no amount of brilliance or strategy can compensate for a lack of honesty. Why? Because shareholders are at the mercy of management decisions. If leadership cuts ethical corners, manipulates numbers, or hides information, investors will always lose, eventually. Fisher gives subtle examples. A company that delays bad news to preserve stock price. Executives who overpay themselves while cutting staff. Management that overpromises but consistently underdelivers. He's crystal clear. If you can't trust management, don't invest, no matter how attractive the company looks. 2. Realism and humility. Fisher deeply values realistic leaders, people who understand their limitations and don't get blinded by success. He warns against arrogant executives who assume past performance guarantees future success. The best managers, he says, are grounded in reality, always looking for ways to improve. open to criticism and feedback, quick to take responsibility when things go wrong. In short, they run the business with a long-term view, not to pump up next quarter's numbers or stroke their ego. 3. Operational insight. Strong leaders must understand the nuts and bolts of the business. Fisher says a good CEO isn't just a strategist. They're someone who understands how every part of the company works and how decisions at the top impact outcomes at every level. He's particularly impressed by leaders who know how to control costs without cutting quality, can identify inefficiencies in day-to-day operations, understand how capital spending decisions affect margins and returns, pay attention to details, not just high-level plans. This kind of hands-on understanding often shows up in subtle ways, in how the company handles customer complaints, employee training, or supplier relationships. It all flows down from the top. 4. A clear and honest communication style. Fisher emphasizes the importance of how management communicates with shareholders. He warns you to be skeptical of companies that gloss over problems, focus heavily on stock price movements in reports, use flashy promotional language in earnings calls and press releases. Instead, he wants companies that speak clearly about both wins and losses, lay out long-term goals and measure progress thoughtfully, treat shareholders as true partners. Fisher often reminds investors to read between the lines of annual reports and quarterly updates. If management spins every shortfall and avoids straight answers, it's a red flag. 5. Long-term capital allocation skills. Perhaps one of the most important traits Fisher looks for is the ability to allocate capital wisely. Great managers reinvest profits into high-return opportunities, avoid unnecessary or flashy acquisitions, know when to be aggressive and when to be conservative. He believes capital allocation is where great management separates itself from average, because how a company uses its retained earnings determines whether it can grow safely and sustainably. Think about companies like Berkshire Hathaway, where Warren Buffett and Charlie Munger made capital allocation an art form. That's the kind of thinking Fisher admires. 6. Continuity and depth. Fisher cautions against companies where success depends on a single star executive. He prefers businesses that have strong leadership benches, organizations where successors are being trained, and where good decision-making runs deep, not just at the top. He also likes companies where promotions come from within. That usually means there's a stable culture and a well-understood strategy guiding the company. How do you evaluate management? Fisher admits it's not always easy to assess leadership quality, but he suggests a few techniques. Listen carefully to quarterly calls or shareholder meetings. Read multiple years of shareholder letters to see if words match outcomes. Observe how they handled tough times in the past. Did they panic, pivot, or persevere? Use the scuttlebutt method. Talk to employees, suppliers, and customers about how the company is really run. A conservative investor's edge. For conservative investors, management quality is one of the few areas where you can gain a serious edge over the market. While many investors chase metrics and trends, few take the time to deeply understand who's behind the wheel. Fisher's advice: do that work, it's worth it. Key takeaways from the second dimension. Great businesses require great leadership. You can't separate the two. Look for integrity, realism, and operational competence. Be wary of overly promotional management. A leader's job is to allocate capital wisely and communicate transparently. Trust in management only when they've proven they deserve it. Fisher's message is clear. If the first dimension of conservative investing is a strong business, the second is strong, honest people running it. Because when storms hit, numbers alone don't keep a company safe. People do. Part 2, Chapter 3. The Third Dimension. After covering the strength of the business and the integrity of its leadership, Fisher now introduces the third dimension of a conservative investment, the ability of the company to weather change. In this chapter, he zooms out to look at something many investors ignore: how a company adapts to the ever-changing world. If the first two dimensions were about what a company is, the third is about what it can become in the face of shifting markets, technologies, and economic landscapes. Fisher's message is simple but profound. No business operates in a vacuum. Change is constant, and even the strongest companies can stumble if they fail to adapt. Why adaptability matters. Fisher starts by challenging the idea that conservatism in investing means avoiding change. In fact, he argues the opposite. A truly conservative investment isn't one that avoids change. It's one that survives and evolves with it. He points to industries that looked bulletproof in one decade, but collapsed the next due to technological disruption. Think typewriters versus computers. Shifts in consumer habits, like print media losing to digital. Regulatory changes, globalization, and outsourcing trends. A conservative investor, Fisher says, must be vigilant not just about what a company is doing now, but how prepared it is for what's coming next. Signs that a company can handle change. So what does adaptability actually look like in a business? Fisher offers several key traits to look for. 1. Willingness to cannibalize itself. Great companies aren't afraid to disrupt their own products before someone else does. Fisher sees this as a critical marker of bold, forward-thinking management. He gives the example of companies that introduce newer, better versions of their own bestsellers, knowing it might hurt short-term profits but secure long-term survival. Think of how Apple regularly launches new iPhones, even though each one eats into the sales of the previous version. They know it's better to lead the change than fall victim to it. 2. Strong R&D culture. Fisher reiterates the importance of ongoing innovation. Conservative companies don't just innovate once. They build systems and cultures around continual improvement. They invest steadily in research, engineering, and design, not because it's trendy, but because they know the future depends on it. And importantly, they're not just chasing fads. They innovate with purpose, aimed at solving real problems or opening long-term opportunities. 3. Nimble decision-making. Large organizations often fall into the trap of bureaucracy, slow to act, slow to adjust. Fisher warns that companies with rigid structures and top-heavy hierarchies may struggle when change hits. By contrast, companies that push decision-making down to empowered, informed teams are more likely to pivot quickly when needed. Flexibility is built into their DNA. 4. Long-term capital planning. Adaptable companies don't just react to change, they prepare for it. Fisher likes businesses that invest in next-generation facilities, expand into emerging markets ahead of the curve, allocate capital toward future-focused initiatives. This kind of strategic foresight allows a business to stay ahead instead of playing catch-up. 5. Transparent risk awareness. Fisher appreciates when a company acknowledges risks openly, like shifts in technology, changing regulations, or demographic changes, and lays out strategies for addressing them. This honesty shows not only realism, but also confidence in their ability to adapt. Companies that pretend nothing will ever change, they usually get blindsided. Red flags. Companies that resist change. On the flip side, Fisher identifies signs that a business might be too stuck in its ways, refusing to upgrade technology or processes, over-reliance on a single aging product line, defensive behavior when discussing new competition, senior leadership that dismisses new trends as fads, poor acquisition choices driven by fear rather than vision. These are not the hallmarks of conservative businesses. They're signs of complacency. Adaptability not equal to trend chasing. Fisher is careful to draw a line between adaptability and chasing trends. A conservative company doesn't jump on every new idea. It filters changes through the lens of its mission, values, and long-term strategy. He's not looking for companies that react impulsively. He wants ones that think deeply about change and respond deliberately and effectively. Why this matters for conservative investors. A truly conservative investor, Fisher argues, is not just protecting capital. They're looking to preserve and grow it responsibly over decades. That requires businesses that can grow sustainably, evolve without losing their core strengths, turn disruption into opportunity. In a fast-changing world, the only safe investment is one that's built to last and ready to change. Key takeaways from the third dimension. Adaptability is essential to long-term safety. Great companies disrupt themselves before competitors do. A strong R&D culture and nimble leadership signal resilience. Don't mistake resistance to change for stability. It's often a red flag. A conservative investment must prepare for the future, not just preserve the past. In wrapping up this chapter, Fisher gently redefines what it means to be a conservative investor. It's not someone who avoids risk altogether. It's someone who understands that real safety lies in strength, intelligence, and the ability to evolve. Because in business, as in nature, the species that survives is not the strongest, but the one most responsive to change. Part 2. Chapter 4. The Fourth Dimension. In this fourth dimension of conservative investing, Philip Fisher zeroes in on something that doesn't show up directly on a balance sheet, but can make or break a company over time. The discipline and skill with which management handles company finances, especially in terms of capital structure and use of earnings. He calls this the fourth dimension because it cuts across everything that came before: business quality, leadership integrity, and adaptability, but focuses squarely on how financial decisions impact long-term safety. This chapter answers the question, even if a company is strong, ethical, and adaptive, can its financial strategy still put investors at risk? Fisher's answer: absolutely yes. 1. The dangers of excessive debt. Fisher starts by warning against what he calls financial overreach. A company can have great products, loyal customers, and solid leadership, but if it's heavily dependent on borrowed money, that house of cards can collapse quickly in a downturn. He's not saying debt is always bad. Used wisely, it can amplify returns. But Fisher draws a clear line. Debt should never be so large that it endangers the business during a normal economic slowdown. In practical terms, this means conservative companies maintain low debt-to-equity ratios. They avoid short-term borrowing to fund long-term investments. They don't issue debt just to boost earnings per share or support share buybacks. He wants to see businesses that use leverage sparingly and strategically, not just to juice stock prices. 2. The importance of self-financing. Fisher places high value on companies that can fund their growth from within, meaning from retained earnings, not from constantly raising capital. He explains that companies which consistently generate more cash than they spend on operations, research, and expansion are in a much stronger position to survive tough times, act quickly when new opportunities arise, avoid dilution by issuing new stock, stay independent and avoid being taken over or forced into desperate moves. This kind of financial self-sufficiency is rare, but when you find it, Fisher says, you're looking at a company that can compound value steadily, year after year. 3. Watching what happens to earnings. Not all profits are used wisely. Fisher urges investors to watch how management allocates earnings. Are they reinvesting in R&D to drive innovation, upgrading operations for better efficiency, expanding wisely into new markets, or are they making flashy acquisitions that don't add value, overpaying executives and underinvesting in the business, hoarding cash with no clear plan? He warns that just looking at earnings growth isn't enough. What matters more is how those earnings are put to work. Fisher wants companies that treat every dollar of retained profit as a precious asset and deploy it with purpose. 4. Stock issuance and dilution. Another financial pitfall Fisher warns about is frequent stock issuance. If a company is constantly issuing new shares to raise capital, especially at depressed prices, it dilutes the value of existing shareholders' ownership. He notes that some companies use stock issuance as a crutch, especially during rough patches. Conservative firms, on the other hand, avoid dilution unless absolutely necessary. Time capital raises strategically, if at all. Keep outstanding shares relatively stable over long periods. Fisher encourages you to read between the lines of financial reports. Is share count quietly rising? Is management using equity as a substitute for discipline? If yes, that's a red flag. 5. Dividends revisited, but with discipline. Earlier, Fisher made it clear he doesn't prioritize dividends, but in this context, he adds a new layer. How a company handles dividends says a lot about its financial prudence. He likes companies that pay dividends only when they can afford to, without harming innovation or growth. Increase dividends steadily, not erratically. Maintain payouts through downturns if the business remains profitable. He's skeptical of businesses that cut essential R&D or staff just to keep dividends going. That's not conservative. That's short-sighted. In short, Fisher wants dividends to be a byproduct of strength, not a marketing tool or compensation for weak capital decisions. 6. Signs of financial maturity. To help identify a company with strong financial discipline, Fisher offers a few key traits: a conservative balance sheet with modest debt, consistent reinvestment of earnings into productive areas, steady improvements in return on invested capital, clear, honest communication about capital spending and strategy. He encourages you to look not just at how much money the company earns, but how wisely it uses what it keeps. A note on cyclical businesses. Fisher acknowledges that some industries like autos, airlines, or steel naturally have booms and busts. In those cases, financial prudence becomes even more critical. He avoids companies in these sectors unless they have superior cost control, minimal debt, and a proven ability to survive and thrive through multiple cycles. Key takeaways from the fourth dimension. Even strong companies can become risky if they handle money poorly. Low debt, high reinvestment, and shareholder-friendly capital allocation are signs of true conservatism. Avoid serial stock issuers and companies that chase growth through constant borrowing. A conservative company should have enough financial firepower to weather storms and act boldly when others can't. Fisher closes this chapter with a powerful idea. Financial strength isn't just about protecting against disaster, it's about being ready when opportunity knocks. The companies that manage their capital wisely aren't just safe, they're built to last. And for the conservative investor, that's the ultimate peace of mind. Part 2, Chapter 5. More about the fourth dimension. In this chapter, Fisher extends the discussion from the previous one. While Chapter 4 focused on how a company uses capital, Chapter 5 drills deeper into how a conservative investor should think about a company's financial structure, especially its liquidity, flexibility, and strategic financial planning. This chapter is all about understanding how a company protects itself, not just from everyday challenges, but from unexpected financial shocks. Fisher's central message: financial soundness isn't just about what a company owns, it's about what it owes, how it earns, and how quickly it can act when conditions change. 1. Balance sheet. Quality greater than income statement. Hype. Fisher begins by pointing out that most investors obsess over the income statement, revenue, profits, EPS growth. But truly conservative investors should spend more time on the balance sheet. Why? Because when things go wrong, like a credit crunch, industry downturn, or market crash, it's the balance sheet that determines whether a company survives or sinks. He looks for high current ratios, current assets versus current liabilities, strong cash positions, not just receivables, low short-term debt obligations that could choke the business in a crisis. The balance sheet, in his view, reveals how resilient a company really is. 2. Conservative versus lazy financial policy. Fisher warns not to confuse financial conservatism with lack of ambition. Some companies hoard cash and avoid risk, not because they're wise, but because they lack growth ideas. That's not what he's looking for. True financial conservatism, Fisher says, is about strategic readiness. It's not about never taking risks. It's about being in control when taking them. In other words, a conservative company maintains healthy liquidity, has access to credit but doesn't depend on it, can scale up quickly when opportunity knocks. This subtle distinction separates companies that are cautious leaders from those that are just drifting along. 3. Cushion and flexibility. Fisher uses a key word throughout this chapter: cushion. It's the idea that a company should have more than enough financial slack to deal with the unexpected. An unexpected loss in sales, a temporary supply chain disruption, a delay in launching a new product. Fisher likes to see businesses with unutilized credit lines that don't carry current interest costs, the ability to cut non-core costs quickly without hurting long-term growth, enough free cash flow to maintain operations and investments, even in a downturn. It's not that he wants companies sitting on idle assets, it's that he wants them ready for the unpredictable. 4. The danger of over-optimizing. Fisher criticizes companies and investors that optimize too much. For example, some firms stretch payables, squeeze every dime from working capital, or minimize cash on hand to boost return metrics. These tactics may impress Wall Street in the short term, but they leave the business fragile. Fisher argues that companies built to last don't run on a knife's edge. They accept slightly lower short-term efficiency in exchange for long-term stability. 5. Expense discipline matters, too. Another topic Fisher brings up is expense control, not just in bad times, but always. He notes that smart companies watch spending like a hawk even during boom years, avoid cost bloat when earnings are strong, review fixed versus variable costs continuously. Fisher respects leaders who avoid corporate obesity and treat shareholder money as if it were their own. That kind of expense discipline makes a company more flexible when lean times come. 6. Maturity structure of debt. He adds a deeper layer to his debt analysis. When is the debt due? A company might have what looks like manageable debt levels, but if that debt matures in 1 year and capital markets tighten, it could face refinancing trouble. Conservative companies, he says, stagger debt maturities and don't rely on short-term financing for long-term investments. This kind of foresight helps prevent forced selling, asset write-downs, or expensive refinancing. 7. Global exposure and currency risk. Though not the chapter's main theme, Fisher briefly touches on companies operating internationally. He encourages investors to pay attention to currency mismatches, like having revenue in rupees and debt in dollars. Understand geopolitical risks, especially in supply chains and local regulations. Assess how well management hedges foreign currency exposure or adjusts pricing to offset inflation or devaluation abroad. Again, this ties back to the same principle. Financial flexibility is safety. 8. What to look for as an investor. Fisher wraps up by giving you a checklist to spot financial strength. Does the company have ample liquidity? Are its debt maturities well structured and conservative? Is capital expenditure aligned with long-term strategy? Does management explain financial risks clearly in annual reports? Is there evidence of disciplined expense management over multiple years? These are the clues that tell you if a business is financially prepared, not just profitable. Key takeaways from the chapter. Balance sheet quality matters more than income statement flash. Liquidity, cushion, and optionality are vital for long-term strength. Over-optimized businesses may look efficient, but often break under pressure. Expense control and capital discipline signal good management character. A conservative investment is one that's ready for both risk and opportunity. In the end, Fisher wants you to think like this. If the economy freezes tomorrow, will this company panic, or will it calmly move forward, make smart decisions, and come out stronger? If the answer is yes, then you've likely found a true conservative investment, one that not only helps you sleep well at night, but helps your money keep working while you do. Ethical and capable leadership, forward-thinking innovation, and financial judgment that protects against downside while nurturing long-term upside. Because in the end, the best investments don't just grow, they endure. Part 3, Chapter 1, Origins of a Philosophy. With Part 3, Developing an Investment Philosophy, Fisher moves from teaching tactics to sharing the personal journey that shaped his entire investment worldview. In this first chapter, he tells the story behind his method, how he arrived at it, why he abandoned traditional thinking, and what lessons molded him into one of the most influential investors of the 20th century. This chapter is less about checklists and more about mental transformation. It's Fisher saying, "Here's what I believed when I started, and here's what I learned the hard way." 1. Starting with the conventional playbook. Fisher begins by reflecting on his early years in finance. Like most young investors, he started by following the accepted wisdom of the day. Look for low P/E ratios, seek high dividends, time the market using charts or macroeconomic predictions. These were the rules taught in the 1920s and 30s, and Fisher initially bought into them. But over time, he found that these strategies didn't consistently work, at least not in the way investors expected. He watched companies with strong fundamentals get overlooked because their earnings had a short-term dip, and saw cheap stocks stay cheap because the underlying businesses were broken. The realization hit him. Buying stocks purely because they looked cheap on paper was not enough. 2. The market is not always rational, but it's often right. Fisher began to notice something else. While the market was prone to overreactions and hype cycles, it often did reflect the underlying quality of a company over time. He realized that rather than trying to beat the market by timing or tricks, he could outperform by aligning with companies that were genuinely superior, the kind that deserved a higher valuation because they were creating real, lasting value. This insight nudged him toward what would later become his central idea: buy great businesses and hold them. Don't focus on the stock, focus on the business behind the stock. 3. A shift toward growth. The big turning point in Fisher's philosophy was his growing interest in growth stocks, companies that were reinvesting their profits to expand, innovate, and dominate their markets. At the time, this was a radical shift. Wall Street was obsessed with value stocks and dividend yield. Growth investing was considered speculative, But Fisher didn't care about popular opinion. He cared about results. He observed that many so-called value stocks were cheap for a reason. They had no future. Meanwhile, some high PE growth stocks ended up delivering huge long-term returns, even if they looked expensive at first glance. The key was figuring out which growth companies were real and which were just hype. That's where his scuttlebutt method and 15-point checklist came in. He didn't want to gamble on growth. He wanted to verify it deeply and systematically. 4. Experience over theory. One of the strongest themes in this chapter is Fisher's belief in learning from real-world experience, not just theory. He critiques the academic obsession with formulas and forecasts. He points out that real businesses are messy and human, driven by leadership, culture, innovation, and adaptability, not just numbers in a spreadsheet. He says, financial statements only tell part of the story. Ratios can be misleading if they're not supported by qualitative understanding. Personal investigation, talking to employees, customers, and suppliers is irreplaceable. This hands-on, boots-on-the-ground mindset is what set Fisher apart from other analysts of his time. It also laid the foundation for the scuttlebutt method that Warren Buffett would later praise as the best way to learn about a company. 5. Trial, error, and observation. Fisher is honest about the fact that his philosophy didn't come to him overnight. It took years of mistakes, experiments, and close observation to develop. He tried trading in and out of positions based on timing. It didn't work. He bought into companies with strong financials but weak management. They disappointed. He ignored innovation in favor of stability and missed big opportunities. Slowly, these experiences taught him that long-term success depends more on understanding a company than predicting the market. Time in a great business is far more valuable than trying to time the perfect entry. Growth, when real and sustainable, is the most powerful force in investing. 6. Investing is a mindset, not a formula. By the end of the chapter, Fisher makes his most important point. A sound investment philosophy is not a set of rules, it's a way of thinking. He encourages readers to think like business owners, not traders. Be skeptical of fads and quant systems. Use both analysis and judgment, not just spreadsheets. Focus more on people, products, and strategy than just stock charts. He argues that building a philosophy takes time, reflection, and discipline. And once you have it, it becomes your greatest asset, your compass through bull markets, bear markets, and everything in between. Key takeaways from Chapter 1, Origins of a Philosophy. Fisher started with conventional investing ideas, but evolved through experience and observation. He realized that great businesses, not cheap stocks, are the key to long-term returns. Growth investing works if you know how to identify genuine, sustainable growth. A true investment philosophy is built over time, through learning, humility, and curiosity. Don't rely on formulas. Rely on deep understanding of businesses and people. Fisher's investment journey is a reminder that the best strategies often come not from textbooks, but from curiosity, mistakes, and a relentless drive to learn what works. And for anyone developing their own philosophy today, Fisher leaves behind this simple truth. Investing is not about being clever, it's about being right, and staying right for a long time. Part 3, Chapter 2, Learning from Experience. In this second chapter of developing an investment philosophy, Philip Fisher moves from the early formation of his ideas to the real-life lessons he learned by actually putting his philosophy to the test, often through mistakes, unexpected results, and hard-earned insights. This chapter is less instructional and more autobiographical. Fisher walks us through key experiences that shaped his convictions, not theories but practical takeaways from decades in the market. If the first chapter was about the why behind his philosophy, this chapter is about the how he fine-tuned it through trial and error. 1. Great lessons often start with small mistakes. Fisher opens the chapter by admitting he made numerous small mistakes in his early investing career, not catastrophic losses, but enough to shake his confidence and challenge his assumptions. He realized that many of his early stock picks were based on partial information. A company looked good on paper, maybe had a decent product or a low P/E ratio, but something was missing: depth of understanding. That's when it dawned on him. To avoid these misfires, I needed to look beyond the numbers and dig into how the business really works. This realization laid the groundwork for what would become the scuttlebutt method, his signature way of researching companies from the ground up. 2. The power of talking to people on the ground. Fisher recounts how one of his biggest investing breakthroughs came not from a spreadsheet or annual report, but from a casual conversation with a competitor's salesperson. That person revealed truths about a company's distribution strategy, customer loyalty, and operational discipline that weren't visible anywhere in financial documents. Fisher made a small investment based on that tip, did deeper scuttlebutt, and watched the company far outperform the market. This wasn't luck, it was validation. Real insight often lives outside the boardroom, in warehouses, factory floors, customer reviews, and supplier opinions. Fisher concluded that first-hand observation and real-world feedback were not just bonus information, they were essential to understanding a company's future. 3. Avoiding the trap of short-term thinking. Another experience Fisher shares is how he sold a great company too early. The stock had gone up 50% in a short time, and he locked in the profit. But over the next few years, that same stock doubled, then tripled. Why did he sell? Because he was focused on the short-term gain instead of the company's long-term potential. It taught him one of his most powerful lessons. A great business often becomes a greater business. If you find one, don't let it go just because it's risen. That's why Fisher began to preach, "The time to sell is almost never," a philosophy he repeats throughout the book. If the fundamentals are still strong and the company is still executing, hold your ground. Let compound growth work its magic. 4. Being too cautious can hurt too. Fisher also admits that at times he was too hesitant to act. He'd find a great company, but because of temporary political fears or market volatility, he'd delay investing. The price would go up, and he'd be stuck watching from the sidelines. That led to a counterintuitive insight. Being overly cautious can be just as damaging as being too aggressive. Yes, it's important to do your research and protect your capital, but when opportunity strikes, when the research is solid and the business is exceptional, waiting can be the costliest mistake of all. That's why Fisher advises against quibbling over eighths and quarters, or trying to time the perfect entry. If it's a long-term play, the extra dollar doesn't matter, but missing the chance altogether absolutely does. 5. Don't let the market shake your conviction. Fisher recounts how he once held a stock that dipped 25% during a broad market correction. He was tempted to sell, fearing the worst, but he revisited his original thesis and found that nothing had changed. Sales were steady, management was executing, and R&D was delivering. So he held, and not long after, the stock rebounded and continued upward. The lesson? Market noise is inevitable, but if your conviction is rooted in deep understanding, you can weather the storm. That's why Fisher places such importance on doing the hard research up front. It gives you the confidence to hold when others are panicking. 6. The role of humility and continuous learning. Fisher admits that no matter how much he studied or how long he had been investing, he never stopped learning, and more importantly, he never assumed he was always right. He learned to admit when an investment wasn't working, reevaluate decisions without ego, stay curious, and keep updating his understanding of markets and business models. In short, his philosophy wasn't static. It evolved through humility. He encourages readers to approach investing not as a science, but as a craft, one where experience refines judgment and mistakes are valuable tuition. 7. Patience beats genius. Fisher ends the chapter with a deeply personal insight. The greatest investors he knew weren't always the smartest or fastest. They were the most patient and most committed to understanding. He believed that anyone willing to study deeply, think long-term, stay calm in chaos, and hold only what they understood well could succeed in investing, even without Wall Street connections or elite credentials. Key takeaways from Chapter 2, Learning from Experience. You learn more from doing and failing than from reading theory. Deep research, especially the scuttlebutt method, beats surface-level analysis. Selling too early is one of the most common and costly investor mistakes. Delaying a great buy out of fear or perfectionism is a form of risk. When the market shakes, rely on your research, not your emotions. Humility and curiosity are essential tools for growth as an investor. Investing success comes more from patience and discipline than intelligence. Fisher's candid reflections in this chapter give readers something few investing books ever do: a roadmap of wisdom forged through real experience. And the heart of it is this: success doesn't require perfection. It requires learning, adjusting, and sticking with what works, even when it's uncomfortable. In investing, as in life, the lessons that cost the most often teach the most. Part 3, Chapter 3, The Philosophy Matures. In this chapter, Philip Fisher reflects on how his investment approach, shaped by trial and error, developed into a fully formed philosophy, not just a strategy for picking stocks, but a deeply held belief system about how to build long-term wealth through thoughtful business ownership. This isn't just the continuation of his journey, it's the point where everything clicks. His principles, experiences, and research methods fuse into something powerful, repeatable, and surprisingly rare. A philosophy that withstands fads, fear, and even failure. 1. From strategy to philosophy. Fisher begins by explaining the shift he made from simply trying to beat the market to developing a philosophy rooted in timeless truths about business. It wasn't about outperforming others. It was about understanding how great businesses grow, avoiding avoidable mistakes, and holding tight to companies that create lasting value. His big revelation: the investor's job is not to find dozens of good businesses, it's to find a few exceptional ones and stay with them long enough for the real compounding to happen. This is the heart of his mature philosophy: quality and patience. 2. Reinforcement through results. Fisher shares that the longer he invested this way, the more the results reinforced his belief. His best-performing investments weren't from clever market timing or obscure hidden gems. They were from companies with strong R&D and innovation pipelines, thoughtful and ethical leadership, a clear growth vision carried out over years. What shocked him most wasn't how much these stocks rose, but how long they kept rising, often far beyond what even he expected. He started to ask a new question: why sell a great business that's still getting stronger? This is where he fully embraced his now famous principle: the time to sell a superb stock is almost never. 3. Avoiding the siren song of trends. By this stage, Fisher had seen many cycles. He watched hot trends come and go, electronics, aerospace, conglomerates, dot-coms, and in today's terms, crypto or AI. Every time people ask the same question, shouldn't we be pivoting to this new thing? Fisher's mature philosophy rejected this thinking. He didn't chase stories, he studied execution. He'd ask, is this trend solving a real, lasting problem? Can the company build a defensible edge? Will customers still want this in 5 or 10 years? In most cases, the answer was no. But when it was yes, he was willing to commit early and hold on for decades. 4. Focused portfolios, not diversified distractions. Fisher became more confident and more aggressive about avoiding over-diversification. He realized that by holding too many stocks, even good investors dilute their best ideas. His conviction sharpened. It's better to deeply understand 5 businesses than to vaguely own 50. This required discipline. Many investors feel safer spreading money across sectors and industries, but Fisher believed that real safety came from understanding, not from volume. So his portfolio often held fewer than 15 stocks, and the largest positions could make up 10 to 15% or more. This was not reckless concentration, it was conviction based on deep study. 5. A trust in time and management. Another maturing element of his philosophy was trust in competent people. He realized that no investor can know everything, but great managers inside companies do know the details. If you back the right management, they'll see threats coming, capitalize on opportunities, make better decisions than outside observers can. That's why Fisher put such importance on long-term vision, honesty in communication, and evidence of disciplined capital allocation. He also accepted that even great companies will face setbacks, but great management turns setbacks into stepping stones. 6. Patience isn't passive. Fisher dispels the idea that his philosophy is about buy and forget. It's actually buy, understand deeply, and monitor wisely. He continued researching companies even after buying them, not to find reasons to sell, but to confirm that. The culture remained strong. The leadership stayed focused, and the competitive edge endured. Patience, in his view, is an active mindset, a decision to not act impulsively, supported by continued confidence. 7. Discipline during irrational times. Fisher talks about periods when markets become euphoric or panicked, and how his philosophy gave him clarity when others were confused. When everyone was selling in fear, he could hold or even buy more because he knew the business was fine. When prices soared beyond logic, he could sit out even if it meant watching others win short term. His philosophy helped him stay rational when the crowd lost its mind. And this, he says, is a huge edge in investing. 8. Investment as a craft, not a contest. In his mature philosophy, investing was no longer a competitive game. It was a craft, an ongoing refinement of judgment, humility, and patience. He wasn't trying to beat the market every year. He was trying to own companies that improve society, partner with visionary leaders, and build lasting wealth over long stretches of time. That's why his portfolio didn't turn over often. He spent more time researching new ideas and less time trading. Key takeaways from Chapter 3. The Philosophy Matures. Fisher's mature philosophy centers on quality, patience, and deep understanding. Long-term compounding from a few great businesses outperforms chasing trends or timing markets. Over-diversification weakens results. Focus on the few companies you know best. Patience isn't passive. It's anchored in research and conviction. Trust in competent ethical management is a huge part of successful investing. Investing is not about clever moves. It's about making smart choices and letting time work for you. By the end of this chapter, Fisher's philosophy is fully formed. It's not trendy. It's not flashy. it's quietly powerful, because while most investors are looking for the next big thing, Fisher is looking for the next great business and preparing to stay with it long enough to let greatness unfold. In his words, the goal is simple: to buy the right company at the right time for the right reason, and then to do the hardest thing in investing: nothing. Part 3, Chapter 4, Is the Market Efficient? In this final chapter of Common Stocks and Uncommon Profits, Philip Fisher tackles one of the most debated ideas in all of investing: market efficiency. And in true Fisher fashion, he offers a nuanced, experience-driven answer, not academic theory, but hard-earned wisdom from decades of watching markets move in ways that often defy logic. This chapter is Fisher's philosophical mic drop. He's not just addressing the question of whether the market is efficient, he's asking, can a thoughtful long-term investor really gain an edge in a world dominated by short-term noise? His answer, yes, but only if you think differently. 1. The efficient market theory, Fisher's take. Fisher acknowledges that the efficient market hypothesis, EMH, which says all available information is instantly reflected in stock prices, has some valid points. He agrees that stock prices often react quickly to widely available news. Obvious mispricings are usually corrected fast. Most investors don't beat the market, especially after fees. But then he delivers his key insight. Markets may be efficient at reflecting consensus opinion, but they are often inefficient at pricing the future. That's where the opportunity lies. Fisher argues that most investors think short-term, follow the crowd, lack the willingness or patience to deeply study a company. So while the market is efficient in pricing the present, it is inefficient at recognizing long-term greatness, and that's where long-term investors with insight can thrive. 2. Information not equal to understanding. Fisher breaks down a major flaw in EMH, the assumption that all investors interpret information the same way. In reality, many investors read earnings reports but don't understand product cycles. They track ratios but ignore culture and leadership. They follow news but skip industry trends. That means the information may be public, but it's not equally understood. This is the key to Fisher's scuttlebutt method. By gathering and interpreting information in a deeper, more human way, you gain insights that others miss or misinterpret. 3. Why the market misjudges great companies. Fisher explains several reasons why the market often underestimates top-tier businesses. A. The power of long-term compounding is intangible. Most investors can't grasp what a business compounding at 15 to 20% annually looks like over 10 to 20 years. So they undervalue sustainable growth, overreact to short-term slowdowns, exit too early when they should be adding. B. True innovation is rare and misunderstood. Companies doing something truly new are often met with skepticism. Think Amazon in 2001 or Tesla in 2012. The market doesn't know how to price innovation until it's already mainstream. This creates opportunity for the prepared. C. Temporary setbacks. Create discount windows. Fisher reminds us that even great companies hit speed bumps. The market often punishes these harshly, assumes setbacks are permanent, overreacts emotionally, but the long-term investor who understands the business can hold or buy more when others are fleeing. 4. The real edge. Independent thinking. This chapter emphasizes a consistent theme across Fisher's entire philosophy. The greatest edge in investing is not data, it's mindset. Most investors fear being wrong alone more than being wrong with the crowd, seek comfort in consensus, lack the patience to wait years for a thesis to play out. But Fisher believes the real gains go to those who Think independently, research deeply, and trust their convictions when the market disagrees. He writes that market inefficiency isn't an obvious gap to exploit. It's a test of character. 5. Efficiency in the short term versus inefficiency in the long term. Fisher draws an important distinction. In the short term, prices reflect noise, headlines, and sentiment. In the long term, they reflect business performance, innovation, and management quality. That's why traders struggle to beat the market, but investors focused on business fundamentals can still succeed. He doesn't claim it's easy, but it's possible. And for those who study businesses, not just stocks, the market provides plenty of chances to buy $1 bills for 50 cents, if you're patient. 6. What this means for you. Fisher wraps up the chapter by encouraging investors to stop worrying about whether the market is efficient and start asking a better question. Am I willing to put in the work to understand a business better than the crowd does? If the answer is yes, then ignore the crowd, ignore the headlines. Focus on timeless truths: products, leadership, innovation, customer loyalty, and competitive advantage. He reaffirms that no formula, ratio, or AI model can replace real understanding, and those who commit to that understanding still have a lasting edge. Key takeaways from Chapter 4. Is the market efficient? The market is efficient at pricing consensus, but inefficient at pricing insight. Information is everywhere. Understanding is rare. Short-term noise creates long-term opportunity for patient investors. Most people misjudge innovation and undervalue compounding. Your edge isn't in finding secrets, it's in thinking clearly and independently. Don't worry about market efficiency. Worry about developing conviction. Fisher ends his timeless classic with a quiet, confident call to action. If you think for yourself, study relentlessly, and hold on tight when others let go. You don't need a perfect market. You just need a great business, a sound mind, and enough time. If you found this summary of common stocks and uncommon profits valuable, don't forget to like, share, and subscribe for more powerful breakdowns of classic investment books and timeless financial wisdom. We want to hear from you. Drop a comment below and share your biggest takeaway from Philip Fisher's philosophy. Which of his principles, whether it's the 15-point checklist, the scuttlebutt method, or the idea of holding great companies for the long haul, resonated most with you? Let's keep the conversation going and help each other grow as smarter, more disciplined investors. Thanks for tuning in, and remember, the path to uncommon profit starts with uncommon thinking. See you in the next one.